Someone asked if today's low was a secure low. It wasn't really a secure low setup, but there was excess on the low today, yes. Hello. All right, I think we can rock and roll. I have, as they would say, all bets, hold all bets now. The wheel is spinning. Fit in one more there. Anyway, there's a good amount to cover here. First and foremost, I want to address the 800-pound gorilla in the room, and that's the Fed. I was trying to be critical, but still respectful of some of the Fed members. Let me see, is that good? Yeah, that's good. I was trying to be critical but respectful, but they are proving themselves to be just morons. Some of the statements and the comments that are being made out of the Fed just don't make any sense to me based on the data that we're all looking at. I mean, unless the Fed, and listen, they might have some special data that I'm not privy to, that we don't know about, but if we're going based on the data that is actually available to us, I covered some of this to some degree in the weekend review video, but I'm going to go over it quickly here again. The Fed minutes, which came out, I think it was a week or so ago, I actually read them cover to cover. I assure you it is very exciting stuff in there. But the Fed pointed out a few things, and I've mentioned that they discussed that they're still running below their 2% inflation target that they hope to achieve sometime in the next couple of years. They want to see if the jobs improve. They talk about lack of business investment, and they highlight regulation as being one of the reasons for that. They talk about, they went out of their way to mention Italian banks, that they see some concern with the Italian banks, and I can't really imagine how the earthquake in Italy must have helped with this. Can't be anything good. Here's where the meat on the bone really comes in. They talk about GDP risk, which is already stall speed, being to the downside. So if you're at like 1%, 2%, the downside is recession. So just talk, yep, someone wrote that, may cause a recession. Marty, very astute guy, that guy. I like him. All right, so you have inflation risk, which they talk about being to the downside. The foreign risk. They mentioned that the Brexit risk, of course, was behind them, but they were watching the fallout of Brexit, but they still see the foreign risk being to the downside. It's not being talked about. This is my own editorializing, but Putin is lined up on the border of Ukraine again. Yeah, I can't see that going too well either. I could imagine that being a shock that no one's talking about, so please keep that in mind. So those are the issues that were mentioned in the Fed minutes, and I want to just go through some of the data and, effectively, oops, a little iffy. The camera flipped on me. Some of the data, and we'll talk about that. So we had a PMI. Was this today's? No. What was? Let's see. Do I have ISM in here? I just want to take a quick look. No, I have durable goods. GDP, Atlanta Fed, Philly Fed, PMI service. All right, so we don't. I'll have to pull up ISM, but that will take 3 seconds. So let's just discuss this like logical human beings. That doesn't always fly on Wall Street. Wall Street is believe it or not, a lot of people believe in. They believe that there's efficient markets. I think it's all just a bunch of people who are paid too much and think they're smarter than they are in most cases. Yes, there are some exceptionally small people on there. Thank you. I'm glad you like my wardrobe. Anyway, so the PMI, the manufacturing, was a miss. The prior reading had been 52.9. The actual reading was 52.1, and the consensus was 53.2. I'm just going to read this to you. Weakness in orders and employment were unfortunate themes of last week's Empire State and Philly Fed reports, and likewise headline the manufacturing PMI report. The PMI, which is based on nationwide samples of manufacturing, slowed by 0.8 in August, flash, blah, blah, blah. Anyway, slowing. I don't want to really sit here and read this to you. It's going to get really boring. But they basically see their employment. There are employment reads inside the PMIs and ISMs, and there's also orders reads. And those are all contracting. They are not expanding. They're already missing, and they're contracting still further. So as hunky-dory as these terrible economic numbers are, they're going to get worse. And they're already saying that in these readings. So I went through the services. That's the waiters, waitresses, bartenders, and I guess we're at the end of the summer, so no more Carnival ride operators. Got to take those big studs out of the numbers. That also showing tons of contraction. Not only ours is, but when we talked about the foreign risk I mentioned earlier, China had a PMI reading last night, and they were a big miss too. It was supposed to be like 52 something, and it was 50 on the nose, which is like the break even before contraction. You think it's coincidence that China was right at 50? I don't know, but not a good number. So foreign risk and domestic risk here is picking up. I don't want to get too into the Philly Fed and all this, but these the Atlanta Fed. I mean, all of these. I'm just looking through all of these numbers. Here's a good one. GDP. This is the growth of the country. We were at 1.1%. That's pretty pathetic, paltry. In post-war recoveries, we experienced booms in the economy with 3-4+% growth. And we are barely hanging on to like 2% growth for the entire economy for the year. The geniuses all think that we're going to pick it up in the back half. We'll have a strong second half. Doesn't matter that the first half of the year was weak. But we know from the PMI and the ISMs that orders and the job quality is all contracting. So there will not be a second half pickup. There could be a second half decline. So the Fed, in their infinite wisdom, is now talking about raising interest rates to choke off already stall speed growth and can't even reach their inflation reading of 2%, which is a pretty piss poor read. I mean, my opinion is that they should not only make their inflation number 2%, they should double it to 4%. And they should really step on the gas here because they're dangerously close to putting us back into recession. And if they hike rates, I can almost assure you that they will. Remember the last time they raised rates in December, what happened to the market? That was also into a growth slowdown. Not a pretty scene. And they will do the same thing again. Interestingly enough, Larry Summers, who is a major Democrat advisor, said that the Fed's hawkishness is making them look foolish. I almost never thought I would ever agree with almost anything Larry Summers would have to say. I'm probably going to go out and buy a lottery ticket after this broadcast. But I agree with him. Their hawkish statements in the face of clearly deteriorating fundamentals and internals, they are incompetent. I mean, this is not just, run-of-the-mill errors. This is the economy here, and these are supposed to be the omnipotent Fed, and they are making themselves look like schmucks. That's it. I'm sorry. This Stan Fisher, who's everyone is all hopped up on, he was a central banker in Israel and South Africa. He's the vice chair here. He put all this weight on this one employment number that is coming out tomorrow. I don't think he liked the reaction to Yellen's speech in Jackson Hole and has everyone now thinking that the Fed is now day trading economic data. That one employment number, not a trend or, not, it goes from one data point to the next, that they could be rock and roll hiking rates with a hot employment number, but then, they're going to back off if the GDP number or whatever is weak. The jobs numbers that everyone was so excited about the last time, keep in mind, came off of two prior huge misses, and this one was jacked up with a ton of government employment. Retailers, I guess, decided to restock some of their shelves and hired a few employees. And I guess the coal companies got tired of the janitors running the machines, so they hired a couple of people. This is not a robust employment report, and the wage inflation that everyone is so worried about, It is non-existent. That is just what it is. That is the reality. And for these Fed guys to pop off, the one piece that, and the reason they're doing this, that they mention is they're worried about a reach for yield. They get worried, and this is what always causes big downturns in the markets and the economy, is when managers get out ahead of their skis. They're not getting a return of 1.5 to 1.6% yield in the treasuries, so they go out and do something genius like buy bonds in, I'm going to pick on someplace, I don't know, Spain or Yugoslavia or some country that should not be having investment grade. I don't want to say investment grade debt, but they reach for yield because they can get more return in those markets than here. But when things go badly, those blow out and they blow up their funds and so on and so forth. And this is what the Fed is afraid of. I don't think they want to do more QE. I think it would be a huge embarrassment to them. And I think that they want to keep the markets tame, because if there's some type of a blow-off scenario, they will have to act again. And interest rates are already basically hugging the zero bound, and I don't think want to have to do more QE. Although if the ish hits the fan, they might just have to. Anyway, I'm trying to keep my cool here, but these people are just, I don't know what they're doing. They're just ruining their reputations, and they are hurting their credibility. And I agree amazingly with Larry Summers. Their hawkish comments are misplaced. That's just it. I don't believe there will be there will be no rate hike in September. If there is, it's a huge policy error, and the market needs to go down a lot. That's just how it is. I think that they can probably get away with a December hike, although they really shouldn't. I think that they're going to try to do that to keep their credit. They're talking about hiking to keep their credibility. It's the exact opposite. They should be more dovish. The only one of them that has maintained their credibility is, oddly, the one that matters, and that's Yellen. She may go off reservation, but when it comes to the press conferences, her last two have been phenomenal. The first one was really good, and the last one was one of the most cogent pieces of central banking discussions that I've ever heard, and I think that's why the market is held up very well, because there is a handle that Yellen knows what she's doing. I don't think she's a Bernanke. I think Bernanke might go down as one of the best central bankers in the history of the world, but we'll see how Yellen goes. It's still to be determined, but so far, her last two pressers, she has maintained her credibility. I don't care what anyone else says, she has maintained the credibility. The other ones, all of them have completely destroyed their credibility. That Esther George and Loretta Mester, these, I don't want to pick, of course I picked the women, I'm going to be accused of being sexist, although I just said Yellen was credible. Those two are morons. They want to hike rates and Stan Fisher, they want to hike interest rates into deteriorating economy. Anyway, another thing, what really is bothering me is you turn on the television. I don't want to pick on anyone in particular, but guys with funny names like to come on and drive a narrative, and it's the TV reporters who have never traded a stock, I believe, in a day in their life, are pushing the narrative of raising interest rates. No matter what these numbers that come out, they're going to be good enough. They tried to move the goalpost today. I forget which one. It was one of the, it was either Esther George or maybe it was Loretta Mester, one of them. One of them said that they thought that the employment number, that Wall Street might be looking at numbers that are higher than the Fed's numbers, and that they'd be okay with 125,000. If you want to talk about the employment report, don't lower the goalposts just because you want to push a narrative. And as far as the employment number tomorrow goes, the range is supposed to be from 125,000 to 215,000. The consensus is 175. That, by the way, will be a big move down from the prior read of 255, which I've already think I've dispelled as not being such a great read after all. Yeah, so I can almost assure you, unless the number is a complete abortion, you are going to hear the narrative of it's good enough, the Fed is ready to go. That will not be the case. What I do think will happen is that the media is going to build up a fear frenzy. They have to have ratings. If everyone's not worried, they're not going to watch the TV. I can tell you from my own ratings. I watch my YouTube views. When the market's doing well, I have lower view rates. When the market's in free fall, I have some of the highest view rates. So I would imagine that the corporations are looking to boost their viewing rate, and they are trying to push a fear narrative, and they do this on the regular news as well. So I don't think there will be a September hike, but I think that they will try to build the fear that there will be a September hike. I think some of that got a little bit dispelled today with that abysmal ISM number. That was just, wow, not good. Anyway, let's talk about what that means for the markets. So I use a little tool. I go on the CME website, and I look. Oh, one other thing. Famed investors. I don't want to mention anyone by name, although I've discussed them on the tube, who have blown up bond funds, who are dubbed legendary investors, saying that there is a hot employment number, the probability of a September rate hike will be 80%. As of the close today, it is 27%, and that is based on the CME website. It's up from 24. It's been rising steadily. It would not surprise me to see this thing get even a little bit higher. It will not get to 80%, is my view. December, as of right now, is roughly 43%. It looks like 42.9. That's what I'm seeing here. Anyway, I do believe December is possible. I do not think September is. Given this data, I mean, they would have to blow the doors off that number on Friday. And if it's another miss and it's junky, and I'll break down the quality, I think it's going to be, I think we're going to be lower for longer. I mean, this data is just, it's just not supporting a rate hike. With regard to the market, how will the market perform? So I have two theories about how this can go, and I'll share them with you right now. We've been in consolidation since we broke out over the old reference high since the July 12th, it looks like. So yeah, it is. Wow, it's a long time already. That was really when we broke out, and it's just been consolidation, and we've had a couple of little freakouts, but for the most part, it's been very narrow ranges. The market has been characterized, from what I've seen, we get a lot of poor highs, which just means there's no excess. You run up, there's a lot of late to the party longs are not getting rewarded, and there are liquidation breaks. You've had a succession of multiple days of poor highs. At some point, those likely should repair. However, it's possible that the cumulative effect of all of these poor highs could lead to a larger than we're used to liquidation break. I am very on guard for that. It could easily happen. So we are either going to get the larger liquidation break. I had thought that would possibly take us to the 50, but the 50 is fairly close. I think that if we did get a larger liquidation break, first and foremost, the 50 would be the first target. The next one would be the breakout of 213.78. I'm in SPY terms now. Between 213.78 to 212.52. And if things kind of get a little cray-cray, like they get whooshy, we're looking to retest the real breakout of 210 to 211 with some gap fill area in 209.53. So I think that would be our downside targets if there was a larger liquidation break. If we are to break out to the upper end, from the Brexit high to low, the 1.618 Fibonacci extension is only 221.09. But if it really kind of gets into blow-off top mode, the channel at this point, if it were to happen tomorrow, and it won't, would be up in 226s. So we're basically dead in the middle of the channel here, and I think we're going to either see the channel low or we're going to see the channel high. And I think we're going to see it soon. So couple of levels. We always go by the levels. Either we're going to buy for the move to the upside or we're going to play for the move to the downside. Here are a few levels that I want to discuss with you now. The Jackson Hole Day range. When there are events like an earnings event or a Fed day in particular, once in a while I use an ECB day if it's in between and there is volatility in the market. There was a very big kind of stalemate doji on 8/26. Today, you can view today as a look below and fail. So I'm starting to think that if we can get up above, and yesterday was a hammer and today was a big hammer, if you can get above the 2-day high here of 216.47, today's high was 216.03, I like to be, I guess I kind of like to be a little bit tougher. Was that? No, I'm sorry, 217.75. That was the high of day. So 217.76 plus would trigger a right or right out long. And I think that a move over these 2-day highs would take you back up to the old all-time high and probably to the 221 in fairly short order. If today's low of day, which was a look below and fail of the Jackson Hole day, if we lose those 2 days, I think the scenario for the larger liquidation break is on for a right or right out trade to the downside. As I said, I think the very first target would at the very least be the 50 MA, the retest of the breakout down in the 213.78 to 212.52, and if things get more out of control, into the 211s and 210s where the 100 MA is and some reference levels. If it were to go, it won't, but if it were to go tomorrow, the channel low is like 207. So that will continue to rise, and by the time you got there, it would probably roughly coincide with the 210-ish level, which was really the big resistance in the beginning, the 210 to 11. So we are going to use over the 2-day high in SPY, which is 217.76, as a buy stop, meaning that we want to be long over that, particularly if it happens in gap fashion. I think that you'll have a lot of people who are trapped short, who didn't cover at the low of day today. It was very stubborn in the market down at the lows, and the same with yesterday. I think you'll get that move to the upside. Conversely, there's a lot, I wouldn't say there's a lot of distribution up here, because the volume, if you look at, I've looked at some volume indicators. There was a really good one that was posted, I saw online the other day. I'll repost it on the stream after this, but it shows that the volume has been contracting. Usually when there's a lot of distribution, when funds are liquidating, volume starts expanding because they're selling. Volume has been contracting up here, so I don't know that there's been a ton of distribution. It was pointed out to me by a colleague. I usually look at I like to look at like weekly and monthly charts in the larger picture, and we are coming off of the Brexit false breakdown. This is very annoying that this chart won't expand. Do you ever discuss how do you rate yourself as a trader? Oh, I'm going to discuss that in a moment. We'll finish up with that. We have a couple of we had a lot of we had a doji as the monthly candle on this chart. So one of this is similar to my levels. This was proposed that a move above that would obviously be a move higher, but a break below the monthly candle, which is 214.25, could lead to that larger liquidation break. But I like my levels that are, I do believe that you could, in my world here that we just discussed here, that would be a point to add, because I want to be even quicker term. So if we get over the 2-day highs, we want to be long, and then we would be looking to add over the old all-time high. If we get the liquidation to the downside, and we get through that those Fed lows, which were, again, where are we, 9-month daily, which are basically below today's low of day, which was 216.03, we would be looking to add on a break of the monthly, which would be the 214.25. So those are the levels we're looking for: the initial initiation and then the step on the gas add. That's SPY. Let's get to some of this stuff you guys wanted to talk about. The IBB. So someone asked about IBB. I'm just going to go right in order here of IBB. Where is the? I'm in the monthly. That's why this looks funky. All right. So this was a very simple trade. I talked about, and unfortunately you can't see the chart, but try to follow along with my logic here. You moved from the high end of the range to the low end of range, and everyone got worried that there was going to be a breakdown. The breakdown did not occur. It rallied back up. It got through the high. Everyone got excited there was a breakout. I told everybody, use it to sell. It has traveled. We've come up from the bottom. You came up from the bottom of the range, over the top of the range, ran the stops, the shorts. They all got, sucked out. You sucked in a lot of new longs, and now it is coming back down. We're right on the 50-day moving average and nestled right below the 200 MA here. So I'll say this. If you're looking to kind of BTD or figure out, I don't know if I would want to initiate shorts right now, but first of all, my upside target, if we are going to resume to the upside, would be 315.55. I just want to draw that in because I'm going to have to delete that piece in a minute because I want to draw in a fib here for this analysis. We're doing this real time. Remove drawing. If we draw a fib, I'm just looking around my camera. I got to figure out a better way to record these videos. Camera's always in my way, or it's just not working for me here. So was this a double top? It was at 299.49. This was 299.25. Yeah, it's close enough. So now we've been in pullback mode. We're testing the backside of the old downtrend line and the 50 MA. This needs to hold right here. If you can get over the 2-day high, I think there could be a trade back to the upside, probably back up to 289. For me, I would be more interested actually in a move lower to get to like the 50% fib or to the 61.8 of the range. The 61.8 is a very, very pronounced volume node in the volume profile down at 262.91. It's also was kind of the breakout of the consolidation in the lower part of the range. I would be interested in a right or right out long there, or to sell near dated out of the money puts if and when we get near there. Could also play put spreads, like you buy I'd have to work it up, but you buy a higher strike and then sell 2 times out of the money down at the 262, whatever you can get that on for a little bit of a credit. That would be a good play in my view. But the biotech, it came up from the bottom. It's pulling back a little bit. It really needs to hold. If you're still long here, roughly where we are, maybe if you want to give it a little bit of, you can give it like a 10-point give, because the 275.40 to 271.77 was really a key reference from past. You really need to hold within these 10 points. If not, we're going to come back down and kiss some of those fibs. So as we continue to kind of pull in, I'd be more interested in kind of buying the pullback here. Some of these stocks, though, really don't look great. Like Bristol Myers, this thing, it was a gap and basically crap. It gapped below the trend line. It kind of tried to rally. Now it's coming back down. It actually broke below the last swing low. I do believe that in the 54.16-ish area, 53.88, that area should hold short term, and I like the idea of actually starting to sell some puts as we come down into those levels. The 51s are another area, so somewhere in those mid to low 50s, I like selling those strikes, because keep in mind, this is basically coming down from an old all-time, from a high, the 77s. By the way, this pattern here that this stock has is very similar to the one Lululemon had. I'll talk about that in a moment. Gilead. and I'm not saying that Lulu is going to go that low, but the setup for like the slow list down and then the gap lower. Someone had asked me on the stream today, was Lulu was this a shake and bake? And I had said no, that the pattern looked very suspect to me, that I'd rather either buy it on momentum higher or wait. And that was really, I hope I saved that person some bucks. So here's the story with Gilead. I've been watching this for an entry. I think I shouldn't say it's too late to short. It's really not. But it is below 77.92. Anything below there is weak. This to me is likely going to get down to like the 70s or 71s as long as it stays below there, and that's where I'd be looking to kind of pull the trigger down in those lower 70s. If you do start getting IV popping, you can start selling some out of the money puts in that area. This Mylan is another one that's been in the news with their EpiPen story. This to me actually, I think that they're combating with a dichotomous situation here. One is they're tone deaf and they picked a bad timing to do this with the politics that are involved here with the price hike. They basically took their EpiPen up to like from like I think it was like 100 to like $600 or something. Not a smart move. But what I like what they did, and I think a lot of people missed this, but I picked up on it, is that they are now coming out with a generic version of the EpiPen, and it's going to be $300. So what does that mean? It means insurance covers generics. So they're now getting $200 more than they were getting for the original one, and it's basically, I think it's sort of a bait and I don't want to say a bait and switch, but I forget what the term is in market. I should know this. I'm marketing. I had a marketing and a double major, marketing and a finance major. I can't think of the term. But basically, you price something high and something low, and then something in between, and use the upper priced item to drag people from the lower one to the middle one. And that's what they did here with this EpiPen, in my view. So I think it's going to be a win. I just think that the stock is trading. It has some technical issues. It needs to basically hold either right here. There's reference lows in the 41.62. So if you want to kind of start feeling for the bottom, I'm okay with starting to sell some out of the money puts between here and like, let's say 39s, 40s. I think that area, there was a reference swing low in the 38s. I think that in this area, it should hold. If you do like a DCF analysis on this, I think the fair value of the stock is really like in the mid 40s. So if I could get this in like the mid to low 30s with put sales, I probably would like it. That's my thinking. So let's go through the other ones. Google is pulling back, and it's doing what it really I thought it would do. It basically got the old all-time high. It punched through a little bit. But this, again, came up from the bottom, came up to the top, and I think people are like now disappointed that this stock came up from 672.66, which was an off an island reversal down there, and ran up to 813. All right already. People are taking some profits. As long as this kind of holds in the range, I think Google is going to go higher. However, if the market gets a little dicey, I would be more interested in selling out of the money puts when it starts getting somewhere between 765.84 and 780. At this point, 780 is a little close, so it'd probably be more closer to the gap fill, like if it could just kind of come down. I'd be interested in selling some out of the money puts. The 50 MA has come up a lot, and there's a big 200 MA and 100 MA confluence at 748. That will be 750 or more when that happens. So I would like to sell those puts somewhere below there. The 50% fib here is 743. The 61.8 is 726. So somewhere in that area would be the strikes that I'd be looking to sell. Somewhere in the mid to low 700s if you can get those puts off as the stock comes lower. So that's my thinking. And what you could do is use those put sales to maybe buy some call spreads. So what I would like to do is one of the games I like to play is buy like a longer dated call spread, like maybe out in January or something, and then sell like maybe October puts against it, or September puts against it. You could even do weeklies as it kind of comes in. So that's my to finance it, of course. That's my thoughts on Google. All right, so BABA. I did a lot of work on BABA in a couple of weekend review videos ago. I said we were now up to like the channel high and it was stalling a bit, but there was some reference levels. There was a gap fill at 98.45, and I had done some measured move analysis, and I threw in some geometric mean analysis. The measured moves would either take you, depending on which one you used, up to 90, either 90, what is this, come on, 99.94, 102.52, or as high as 110.49 with a geometric mean, which it's basically similar to an arithmetic mean, except that it what I like about the geometric mean is it factors in the worst scenarios a little bit more. So that would be 104.01 roughly. So let's just say 104. 1.618 fib extension was 103. So I think that 103, 104 area is a really good target for BABA. I was in a call spread, which I was stopped out of on, what day did I stop out on? It was 8/22. I got back in on the break of the kind of the listing downtrend on 8/30. So I've been in it for the last couple of days, and I'll use a stop below that low. So if it can't hold 95s, I'll be out of there again. So I may even tighten it up. I'll probably draw a trend line, and if it break, from the swing low from 825, if you draw a trend line from there, so you could use that as either that as a stop or a break below 95s. It really should not do below 95s again. If it does, there's something wrong with the stock. I think that they're going to do like what Amazon did, the web services, and first of all, they killed their quarter. They had an amazing quarter, BABA. They just blew it out, and I think that their story is really coming together. I think BABA was really a case like maybe like a Facebook. They came public during a transition period when Facebook was going from online to mobile, and the street got to see how the sausage was made, and it was not pretty. I think that's what happened in BABA, but I think that we're kind of ready to go here. It seems good. If not, like I said, if you lose 95s, I'll probably be out, and if it loses 93.12, I'll probably be short. As crazy as that sounds, playing for the gap fill, but mindful that I'd be looking for a long entry again at some point. I do think that this stock will see higher, but it has to hold levels. I mean, that's just how we play this game here. But NVIDIA, speaking of high flyers, this stock is just like, I think walks on water. Holy freaking wow. Stock is just like a monster. I'll keep it simple, stupid for you. If you could use today's range. If you're long or you're late to the party or you're looking for a place to place a stop, I got to just plug my iPhone in here. The battery's dying. I think you could use the either today's low, 60, 76, even better. That's really the range low. You have now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days of range consolidation. Anything above those days is going to go higher. Anything below that range, it is going to get a liquidation break to the downside. So above 63.5, it's long. Below 60, 76 is a stop or right out short. Keep it real simple with NVIDIA. Start crossing some of these off so I know what I've covered. I covered IBB, I covered Google, I covered BABA, I covered Gilead, I covered NVIDIA. I have IBB written down twice. I guess people were really excited about that one. What do I want to cover next? I'm going to jump around a little bit here. While we're talking tech, let's do Apple quickly. So Apple had a lot of MOC orders to buy yesterday and was looking like it was getting portfolio allocation. I mean, you really have to be doing this for a while. I don't expect you guys to notice this stuff, but today was the first day of the month, and it just looked like it was getting portfolio allocations to me. Like, even as the market was like tumbling down, Apple was like holding up like a rock. I don't know if that's going to continue past today, but wouldn't be surprised to see a little bit more if we kind of hold above the last 2 days highs, which we did. Today was actually something Apple hasn't done in a while. Excuse me. Apple, for the first time in like a couple of weeks maybe, has now closed above a prior day's high, which is an interesting sign. I think that it's going to get a 10-day MA test at the very least here, which would be 107.49, and could even get back up to the old range low, which is 107.85, maybe 108. Yeah, so I think that is probably in the cards for Apple as long as it can hold over 106s. It really has to hold 106s. If it doesn't, it may pin 105, but I don't think it would hold 105 for much longer. There is a channel low coming into play. If it were to happen tomorrow, which it won't, I don't think, it would be in the 103s. 103.74 is a really, really key level in Apple, as is 100.72. Those would be my downside targets. If it were to like lose 105 half is the must hold. If it loses 105 half, the stock is going lower. You could be looking between 103 and 100. If it, like I said, holds over 106 half, that area, it's going to go higher. So below 105 half, it's a short, and above 106 half, it's a long. Keep it really simple, stupid with Apple. All right, so that's Apple. Someone was PayPal. I haven't looked at this one officially in a while, but it's kind of just chugging around reference areas. Longer term, I think this stock is going to go higher again, but it's sort of marking time, I think, until their next earnings report. The 36, 37 area is key to hold. If it loses that, it could maybe see the 35s, but I have a small long in here, roughly around from these levels, so I'm just going to hold on to it for a little while. I had played this long, talked about booking profits, and then got back into it, so I'm kind of just marking time with this one here. But I like PayPal. I wouldn't even mind selling puts to get in. I may be looking to add to this if it can start, getting back over the 50 MA. That I'd be looking 37.68 area. If it can get back above that area, I'd start thinking it's firming. A little below there, it's a little vulnerable, but I would start looking to add over 37.68 with a tight stop, of course. That's PayPal. This match, this isn't one I like to talk about all that often. I'm a little shy. No, I'm just joking. 16, 17, it really needs to be back up over there. I actually used yesterday to book some profits and some near-dated short puts. I actually resold some. If this got below and closed below the 50 MA, I would just take those off again and wait for the channel low. So 50 MA plus, I like it. Below, I don't like it as much. That's match. I don't cover Avago very often. It's not really one I follow that often. Let me pull up this chart. I haven't discussed this, I don't think, ever. I did with Broadcom. Stock is pretty, this is still Broadcom, but I mean when it was BRCM. I'm going to just draw in a simple trend line here. I mean, the stock is clearly getting a little extended. Just drawing in some lines here. I don't really have much of an opinion on this pattern, to be honest. The 20 has been important. It's looking like it's starting to stall a little bit here, actually. This could be a mini secure high. When do they report? They report on. Did they report already? Yeah, they just reported. How did they report? Let me take a look. Intraday, 1 day, 5 minute. Oh, it's all over the place. Oh boy. All right, so we're gonna have to. I would have to look into the conference call. I'd have to look at their numbers. They just reported their number was. It looks like a pretty decent beat. I don't know what the revenue numbers were in there, but with a beat and it can't go higher, I usually think it's going to go lower. So let's go back to the daily here. If this is a secure high setup, you can be short against 178.32. Anything above that, I think, would be a stop out. And the stock is roughly trading now at 173. So yeah, I mean, there's a few dollars of risk in there, but yeah, this to me looks like it's due for a little bit of a short-term pullback. If it couldn't go higher on a good number, it's probably going to pull back lower. I'd be looking to step on the gas on the short below, yeah, Avago we're talking about now. Anything below 174.37. What is it now? Like 174. Yeah, anything below 174.37 is vulnerable. Let's just keep it that simple. So below the 78s, it's a potential mini secure high, and below the 174s, it's vulnerable to still lower. Those are the key levels. Lockheed Martin is one I've been looking to buy. I hope I didn't miss my opportunity here. Like M&M, right? If you only had one shot, one opportunity. The stock is coming down off of an all-time high, so I'm not afraid of this thing completely collapsing. Usually what you get is a throwback to a lower high before the real danger begins. We haven't had that throwback yet. Yesterday was a nice reversal day. I was actually thinking about buying it, but I want to see if it could get back up over the 50 MA, I'm sorry, the 100 MA and the 245.37. If you can start clearing the 245.37, I think that this will see the 50 MA, which is up at 253.60. No, 255. What is this? I can't. For some reason, this is not showing. It looks. I think it's in 252s, but hold on. Got to zoom in. 252.71, and that would coincide roughly with the backside of the channel. I'm really looking for this for a buy. Like if this were to roll over again, somewhere between 234.75, which is the old reference low. Like I would love if this didn't kind of have the rally now and it came back down. And the channel low, which is currently around 231s. The 50% fib is roughly 224. The 61.8 is a little aggressive. That's down in the 213s. I think you would really need the market to roll over for that. But if this got down to like 234s, 231s, I'd be looking to sell puts below 224 strikes. So that's my theory on Lockheed. This looks like it's going to rally back up. If it did, you could also try a short at that 50 MA. That was also the kind of the swing low before the move to the high. I'll go over this one in my weekend review video. I think that would be a little bit more helpful, but I think it would be a good write or write out short around the 50 MA or a buy a little bit lower. Visa, not one I cover very often. Poor highs, piss poor highs. Let's see, 2-year daily. This is already banging up on this area a lot. Well, we've had 1, 2, 3, 4. This is now going to be like the 4th or 5th test. I want to say this looks like it wants to go higher, but I've had trouble with Visa before. Like I've traded it and it's been like a disappointment. Like it eventually goes, but it doesn't do it in my option series. Like I once played the rolling game with this. Eventually I got it, but it was sort of like yeah, it was sort of like a tie web. Have you ever seen a crisp $50 bill? That's sort of what I felt like when this thing did it. But it looks like it wants to break higher. The pattern looks okay. I would be more of a buyer on the 50 MA, 100 MA confluence. Like if this were to back off again, I'd be down, sort of down to buy it down there. So if you want to try it right or right out, you can do it with a stop maybe below the 20 MA, or look for the 100 MA and the 50 MA confluence. Yes, I cater to a very few who actually understand some of my jokes. Gold. Let's talk about gold. So this is getting slizzammed because of the dollar, right? The dollar rally. So gold is gold, oil, all of these commodities are priced in dollars. And as the dollar rolls higher, the gold is going to go lower. So there's a channel and a 50% fib and the retest of one of the breakout areas, 123.93. There's also 100 MA down there at 123.77. So I like this right or right out in 123s. If you lose 123s, you'll have snapped the channel. But with the 1.618 of the range and a big volume distribution is, actually the big volume distribution comes lower, but 121, so between 121 and 123, that area is a good right or right out area for gold. In GLD terms, we're talking now. I like this though, the 123.93, coinciding, the breakout area coinciding with the 100 MA, and the channel low. So this 123s has to hold. If it loses that, you could fill the gap. There's a really big gap down to 120. So let's talk gold here. Right or right out, 123s, a break, and we could try short to 120. To 120 to 118, actually. There's a lot of room down to those areas. So that's what I'm thinking gold. Right or right out long here, a little lower, or right or right out short on the snap there. The ideal scenario, by the way, for that short would be a bounce and then go through. An immediate breakthrough on this, I think, would probably be a little bit too fast, and you'd probably get a bounce to the backside of the channel and then go. So I'm not looking to really short the initial snap, but I'm looking to short the bounce if there is a snap. I'll show that in the weekend review. It's a little complicated, but I assure you it's not as complicated as you think. I've done these plenty of times. So let's talk about the trader survey. Someone had asked about that. I don't have it in front of me, but what bothered me is a few things. Can I pull it up? Let's see if I can pull it up. That would be, I don't think I can on the computer. I probably could on the computer, but what disturbed me is that most people answered that they were average, and a lot answered that they were poor traders. Okay, let's address this. I don't wake up every morning, and you shouldn't wake up every morning. This is my opinion. And go to work and do something that you feel like you're just average at, and for sure not poor at. If you really love trading and you want to be great at it, spend the time and really learn how to do it. It's this sort of like, I want to say that trading is like sports. You can practice and get good, and you'll be a good utility bench player, but some people have more natural talents, and a lot of it honestly comes with experience. So rather than blow up your accounts, I know it's boring and makes no sense to trade if you're not trading real money. There is a degree of truth to that, like where, you know, if you trade in a paper account, you could get filled in something, or you won't necessarily make the same emotionally driven decision as you would as if your own cash is involved. But learn the rules to the game before you play. I think that really would help improve people's P&Ls a lot. Spend a couple of weeks or whatever and just learn how to read the tape. Look at a stock, look how it's behaving before it has a big run to the upside, or look at a stock and see how it's behaving before a run to the downside. Get to know price action, get to know the characteristics of a few stocks. I keep my set narrow. I often talk about that scene in Hitch where he's, forget the guy's name who's in The King of Queens, but Will Smith is teaching him how to dance, and the guy's like, okay, I got this, and he does like all these crazy moves, and then Will Smith kind of smacks him and is like, arms like this, and your zone is here. That's honestly me. I am like here, my zone, I keep it really tight. I have a few stocks I follow. I know them really, really well. I know when they're behaving properly for moves to the upside or the downside. And if I don't know, I'm out of the trade. Honestly, I'll tell you, someone was asking me today to check some other technician's work or whatever, and I said I honestly don't, or what do I think? I honestly don't care what anyone else thinks. It's crazy. I know it sounds obnoxious, but I really don't care what anyone thinks. I care what I think. Like, I could honestly be asked about a trade. I could survey a room with 100 people, and every one of them could say it's a long, and I'll still short it if I think I'm right. I don't know I'm wrong until I lose money. That's really how this game is truly played. And if anything, 100 people said it was, let's say it was a long, they're already in the trade, so of course it's a short. It's overly crowded. But anyway, back to what I was saying. You have to be able to do your own work and your own analysis. I know a lot of you rely on me, and you're getting, frankly, quite great high-quality work. I do a lot of work on my charts and so on and so forth, and I've been doing this for a long time, and I have a lot of experience seeing price action. I mean, I've been trading really, honestly, for like 20 years. I started this when I was a kid, when I was in my teens. Not professionally or semi-professionally or whatever you want to say how I'm doing it now, but I've spent a lot of time in a lot of different types of markets. I traded in the 90s. A lot of these guys who are running funds now, I didn't trade back then. I've seen a lot of different types of markets. I traded during 9/11. I traded in 2008 and 2009. I traded in 2013. I'm trading now. So I've seen how the market behaves, how characteristic things are, and I'll tell you, just spend some time, get to know the market, get to know a certain narrow subset of stocks. Don't go and turn on the TV and see this stock is up 40% and feel like you have to chase it, or something's down huge and feel like you have to be the one to grab, to be the knife catcher. Do the work, do your setups, plan your trades ahead of time. I once in a while, I'll be on the fly and I'll pick something up and, it'll play. But for the most part, 90% of my trading is methodically planned out before it happens. I am in because something triggers and I've planned my upside of the move, or something triggers and I've planned my downside of the move. And that's why when a stock like Taser, that I was long for a long time, got up to 30, I wasn't buying, I was selling it up there. That was planned. I was probably one of the first orders filled in the 30s. I was on it immediately because I knew that's where the stock had broken down from. People who didn't necessarily look at the charts or hadn't planned didn't know that. The same thing with Apple. When it was 109.85 to 110, I knew that was where the stock had broken down from. These, you have to be ready. Same thing with buying. Something's a 61.8, or this or that. Plan the trades ahead of time. I think that the famous saying is, failing to plan is planning to fail. Plan your trades. Don't do things on the fly impulsively. Keep an eye on your P&L. How are you doing in regard to the market? If the market's up, are you making 2 or 3 times the amount of the market? If so, you're probably positioned well, but getting close to the end of the run. Also, conversely, if the market is going down, are you doing better or worse? Usually you want to be doing better. I'll tell you, one of the big tells for me that we're getting near, let's say, a market top, is that I don't even know. I beta weight my portfolio, but if the NASDAQ is up a little bit and I'm up multiples of that for multiple days in a row, I know it's getting time. I'm staying past my welcome. It's the house party when the parents are going to be home soon. or whatever. You want to be starting to learn these things, these feelings. The stock market in the end is all about supply and demand, fear and greed, and what you should be looking to be greedy when other people are fearful, and fearful when other people are looking to be greedy. I don't really know a better way to describe it than that. Often I look to catch the meat of a move. I often do have really great trade location, like selling near the top or near the bottom. It's not even always like the exact number, but it's really pretty close. But that comes with some experience. And it's not necessarily purposefully so. Like, I don't aim to be, to catch. I mean, listen, I try to always catch a bottom or a top, but I don't need to milk it for like the last couple of cents and then have the thing gap down on me huge the next day. Just take profits along the way, raise, discipline, use stops. Don't be, I'm trying to think of the best way to say this, but if you feel that you're not performing well or you're consistently losing money, you want to make an evaluation in should you be doing this or should you not be doing this. And my take on that is if you're willing to do the work and put in the time and you're seeing some improvement, you should stick with it. But if not, and you don't have the time and you think it's going to be something to make a little extra money in on the side, you have a real job, it might not be something that you want to dabble in. Trading is a profession. I wouldn't wake up one day and say, hey, I'm going to read a book over the weekend or read some guy's blog and then go out on Monday and think I can do brain surgery. It's the same thing. It's a skilled profession, and you really need to know what you're doing. Anyway, we're getting a little late here. That's my story. I'm sticking to it. I will have a weekend review video up on Sunday night. Maybe Monday. We'll see. I think the market's closed on Monday, right, for the holiday. I'll probably try to get it up on Sunday anyway, though. Anyhow, that's my story. I'm sticking to it. Please, if you came into this video late and want to watch it again, it's going to be on my YouTube channel shortly. That's Justin Pulitzer Trades. If you're not following me on Twitter, get on that. It's at Justin Pulitzer. Anyhow, I'll see you guys on Sunday. Have a great holiday weekend. Enjoy the remnants of summer, and cheers.